we're going to talk about this article that I came across where Google 2 weeks ago reported that the search, when is the housing market going to crash, had spiked 2,450% in the past month. It went on to also say that at the start of the month, being April, 42% of homes were selling for more than their list price, according to the real estate brokerage Redfin. And that was 16 percentage points higher than the same period last year. And this started to, concern me, as I'm sure it's concerning a lot of our clients. And I thought that we needed to have a conversation about this so that we would have talking points to speak with our clients about. In addition, in another telling indication that some people thought there might be a bubble was the search term, how much asking price should I offer on a home in 2021? That jumped 350% in that same week. So that got us thinking here. We see that home prices in February were up over 10.5% from last February, which is the largest annual jump since 2006. And according to Jeff Otto, New Jersey prices were up 11.5% in 2020, but in 2021, he thinks will only be up around 6%. So there's obviously concern. People are reaching out and looking to find answers to this. So part of what we want to do today is to come up with some answers to those questions to help you navigate the circumstances that we find ourselves in now. One of the major things that we feel we need to clarify right away are the differences between what's going on in the market today and what was going on in the market in 2008. Because people are concerned that we're coming to the edge of a cliff and we're going to just crash like in 2008. But the circumstances are totally different here. First of all, in 2008, there were a glut of homes on the market. And obviously we know now that the condition we're in right now is that there are hardly any houses on the market. In 2008, lending rules were dramatically relaxed, which allowed people to get mortgages even though they may not have been perfectly qualified, let's say, to get those mortgages. And that led to a spate of foreclosures. Today, investors are heavily involved in the marketplace, and they're actually offering a support system to the market through adding rental properties, which will help offset any of the shortfalls and the growing expectation of possible foreclosures. There will be a rise in foreclosures. We do see that, but it's certainly not going to be to the extent that it was back in 2008. In a really great statement for supporting our actions going forward and talking to our clients, Lawrence Yun, the chief economist for the National Association of Realtors, says that the market is hot simply because of the shortage of inventory and rising prices are normal economics. As soon as more people are vaccinated and feel more comfortable with buyers coming through their house, there will be more inventory and a lessening of price hikes, and the extreme bidding wars that we see now will certainly slow down. We're also starting to see selling prices, according to some of the financial experts, that selling prices are starting to flatten a bit. There has also been a drop in mortgage applications, which means more buyers may be deciding to sit this out for a while, which leads to the sentiment that this is not a bubble or a runaway home price speculation, but just the sheer economics of supply and demand. And the feeling is that the supply side is definitely going to be picking up, and the demand side might be slowing a bit. All right, Rob, I know that you have a lot more that you want to go through.
You're muted, Rob.
All right, let me unmute myself and talk a little bit more about my practical approach to this. And I think that, I kind of tried to combine some of the data out there with some really basic common sense. So stay tuned here. If you could put your camera on, if you don't mind, I'd just like to feel like we're having a more of a conversation as I go through, as I nerd out with my numbers today. So, Rob's thoughts. The real estate is booming for several reasons. One is what I'm going to call it the Great Migration, right? A change in preferences due to pandemic and changing workforce requirements. For example, my brother was working on Wall Street. He then moved to Hoboken, and now he's doing the same exact job, same exact position from a beach outside of Jacksonville. So that is the changing workplace requirements. I don't think we're ever going back to pre-pandemic. There will be ebbs and flows, but the Great Migration is now a fact. The second fact is the printing press. Okay, the government, in response to our pandemic, has probably overcompensated in providing stimulus. And what has that done? That has propped up asset values. And asset values that it's propped up are residential real estate and the stock market, right? So if you own stocks in your 401k, if you're a stock trader, you probably don't need to be very talented to do well in this market. You just throw a dart at the market, and for the most part, it's going up. I want to share with you a fact, okay? February 2020, the money to February 2021, the money supply, that's the amount of money in circulation or available to people, is increased by a whopping 26%. So is there anyone that, there's 26% more funds out there, and the assets are essentially fixed. What is that going to do to assets? Who wants to venture a guess?
Increase the price, Rob.
And what would be a good ballpark number?
At least 25% if the money supply increased 25%.
Money supply increased by 26%. So I would say if all that money goes into the ecosystem, into the economy, it's going to bid asset prices up probably something similar to 26%. I do believe that some of those assets are sitting on the sidelines from skeptics, so that impact might be a little bit less. I spoke to a money manager who has a building next to one of ours, and he's telling me, Rob, it's incredible. He's like, I'm doing such a great job by doing nothing. He's like, and there's so much money on the sidelines, I don't see it ending. So that's one man in the financial services industry saying that there is tons of cash on the sideline. Money supply has increased by 26%. Good for real estate outcome. Right, Anthony? Thumbs up? All right. Any takers on that one?
Keeping the affordability there for the buyers on a monthly.
And who's got that interest besides us?
Everybody.
Federal government wants to see affordability, right? Federal government is that's managed by the Federal Reserve. So the Federal Reserve and the federal government, they have a policy initiative to keep housing affordable, right? Because that's kind of a good thing, right? People can afford and stay in houses. There's no subsidies, less homelessness. We all agree, yes? Okay, so policy implications, and you're going to see that I'm going to stack on a very good argument for us as to why things are happening. The third, so interest rates are low. And this is a quote from when I Googled it. The Fed has signaled from its FOMC meetings that it expects to keep its short-term interest rate at a record low of between 0 and 25 basis points, or 0.25%. For those of you who aren't numbers people, that's a zero, a decimal point, 0.0025. So you have a 0 dot, two more zeros, 25. Okay, it's not a 2.5%. That's 1/4 of 1% and 0. The Fed's drive to keep long-term interest rates low have helped hold down mortgage rates. Anybody disagree with that? And fuel home sales and price increases. Basic supply and demand 101. My Rob's note number 4, housing is a basic need. We all need housing. And over time, I believe rents are going to go up, right? And if rents are underlying factor for housing, what is that going to do to home prices over time? It's going to keep them fairly stable or increasing, correct? So there's point number 4. And I'm going to share this with you all with the recording afterwards. Regulations to build new homes are increasingly restrictive and expensive. Anybody have any experience with that? Who can give me a hell yeah for that? Did you ever try to get a building permit in New Jersey? All right, trust me, it's not that easy. It's more difficult with all the regulations, environmental, land use, everything else. It's harder to get building permits.
Rob, it's not just that. Between lumber and steel costs, everything is up. Everything is up 25, 30%. And it just doesn't make economic sense to build anything right now. And you know the projects that I'm involved in, and it's I have to literally add 25 to 30% to the costs of everything that we're doing.
You know, Carlo, I hate the way you think like me. Number 6 was construction costs are rising well above normal inflation. Number 7 is labor is hard to attract and wages are rising due to the relaxed unemployment standards and eligibility, right? Anybody have any other factors that you're seeing? I want this to be like a collaborative document here. And, you know, Carlo, that literally was my number 6.
So Rob, one thing that I think you haven't spoken about is who buys all this debt.
I'm gonna talk at a macro level a little bit, Anthony. But like, what other underlying forces do we see? Because I have 2 or 3 others that are going to anchor real estate valuations to the point where we're comfortable as an asset class, you know, investing in it. Anybody? Bueller? All right, I'm going on. I know you guys. I know you're a shy bunch today. This is something I believe is really going to help sustain our value, which is lending standards have remained consistent and reasonably conservative. Anybody want to disagree with that one?
Not necessarily disagree, but they have on a commercial side, they've relaxed certain things. They've relaxed, it didn't go away, but they relaxed certain escrows, down payment, they have programs with a less equity placement, but by and large, it's relatively the same. They'll just do a little bit more relaxing as any bankers feel that it gets toward the end of the cycle.
Fantastic. So, but there's no, Carlo, to your point, there's no residential like 580 FICO score, 102% financing on a pay option arm with neg am, right? We haven't heard.
Yeah.
We haven't heard the term pay option. We haven't heard neg am. As a matter of fact, I think that might even be illegal now, right? Negative amortization.
Didn't negative am go away in 2010?
It might have went away with federally sponsored or federally insurable debt, but
Yeah.
But there's no neg am loans. I mean, years ago you could come buy a house, and many of our guests here, Carlo, probably weren't that familiar with it back then. I'm sure most were, but many weren't. You could go buy a house, and let's say you bought a house for $500,000, and let's say the interest rate was 6%. That's $30,000 a year. There were lenders that would say, hey, instead of paying $30,000 a year plus some principal, we'll let you pay $15,000 a year, and we'll add it on the back because we believe that housing prices are going to go up at infinitum, and we don't really care if you pay the loan off, right? That was what these Wall Street people had done. So those products are gone. I haven't seen one in years. Limited speculation purchases, okay, from somebody around in 2006, from somebody who saw the Florida market. Colleen or Julio or anybody down, any of our Florida partners, can you tell me if you were in business in 2005 and 6? If you could just unmute yourself, please.
Sure. Yes. Like you said, there was a lot of speculation and people were just buying properties just to buy them and then flip them again. In the market.
I'm going to guess that you had people buying homes that didn't even take the time to fly down and see it, right?
Correct.
So it was unyielded, unregulated, speculative buying that bubble burst. Okay, it got ahead of itself. So there's limited speculative buying in this market right now, in my opinion. Does anybody see it differently? Fantastic. So, and then the last piece, this is my top 10, and I'm sure there's more reasons. And if you could put it in the chat, if you have some others, homeowners have more equity than in recent history, which should minimize the foreclosures or the foreclosure risk, right? Because if values have gone up, even if you're in forbearance, you might have burned your credit, but chances are you could probably still get bailed out by selling it at the appreciated value instead of going to the gavel. Okay. Or jingle mail, as they used to say in the lending industry, where you mail the keys back to the lender. Does everybody kind of see how, if we didn't do 120% financing, we did traditional lending, and the home values have appreciated, how that should put a cap on, if you're looking for the foreclosure market, I think that might put a cap on the foreclosures that are coming, because you have all these investors saying, hey, I'll buy your house. It doesn't take that much of a genius to figure out how to get out of a foreclosure, right? You just sell it and take the equity if you've been semi-responsible, even if you put it into forbearance. So those are my top 10 reasons why I think the market the ice is thick. It's safe to walk on. It's a good investment class. Now, I'm going to go bipolar on you. I'm going to give you the arguments for the other side. How's that sound? Anthony, good?
Well, the one thing that you didn't add is demographics, but I'll wait. I don't know if you're done with your part yet, but millennials, I think, are very important to this segment because they're bigger than the baby boom generation.
I like that. See, Anthony, you're going to co-host with me. So, anyone else have any arguments or any rationale for why the market's going to remain strong? Just unmute yourself and chime in. Now I'm gonna give you the opposite side, okay? And if you could please put your camera on so that we could see it, I would appreciate that. I just feel like it's a more regular meeting. The arguments against buying real estate, because we have to look at all the sides, kind of flies in the face of what I just said, but mortgage defaults and forbearances last year saw the largest number of homeowners in default or forbearance. At the peak, it was almost 4 million homeowners were in default or delinquent. Now, to keep that into perspective, like when I throw out numbers like 3.6 or 4 million is a number, right? How do we bring that home where it has some meaning? Anybody?
How many homes total?
So let's take a look at how many homes typically sell in a year, Anthony. It's historically pre-2000. It's been like in the 5.5 to 5.7 million range. Now let's just say, hey, here's a tidal wave of 3.6 to 4 million potential homes coming into the market because they were in forbearance. That would certainly provide an exposure and a welcome to our home buyers, right? Hey, if there's another 4 million homes coming on the market, hey, maybe I want to wait. I'll get a better deal next year, right? So that's one counter argument. Another counter argument is more government debt is likely to erode the affordability of homes, right? Does anybody see the tax environment getting better or more favorable for us in 1 to 5 years? Anybody raise your hand? So Robert Garver, make a note that nobody is seeing the tax environment getting better for us in the next 1 to 5 years. So that's a downer, right? I mean, that's going to affect affordability. If you have less money to buy because you're getting taxed, you can't afford as much on a house. Another impact for those of us in New Jersey, is the local taxes. Right? I mean, we have a moderately high income tax in New Jersey on a progressive level. And I think that's going to provide a increased exposure to the higher price homes as opposed to the entry level and trade up homes. The second thing is property taxes. Who trusts property taxes to go down or to be stable with the economy? Anybody? No. So that's another pressure on why not. So I shouldn't say this, but New Jersey has the highest property taxes in the country. We have good schools. We have some good services, but we do have a very high property tax rate. The average effective tax rate in New Jersey, who wants to make a guess at what that is? Anybody? So if you buy a $400,000 home, what do we think the average taxes are going to be on that?
12,000.
Anybody else?
10 to 12, yeah.
So the average is 2.49%. So effectively 10,000. Some areas are much higher. Some areas are much lower. But that's our effective property tax rate. We see inflation, or excuse me, we see taxes likely to go up. Will New York City jobs return? I'm going to mute everybody because I hear a background noise here. Hold on.
Oh, that's probably my shredder.
in my opinion, New York City.
Sarah, you were talking?
I think the New York, since I live in New York, I think that the jobs will return and the tenants will return because the traffic. They're not going to want to deal with Jersey.
Okay. So there's a point and a counterpoint, but I think probably the best case scenario is we get back towards those normalized levels, and the worst case is employers have realized that they don't need these massive offices in New York City, thus minimizing the benefit of having public convenient transportation. Robert Garver, what did we talk about the value that Jeff Otto had assigned to a Midtown direct train line to a community? Mr. Garver?
About 11%.
So, and just by having, like, compare Summit to Westfield, where we have to transfer in Newark or Secaucus to get to Manhattan, Summit has a Midtown line, and Jeff Otto and some other big thinkers have assigned a value of about 11% to the home value. So if the benefit of commuting to New York City is not as grand, that might put some pressure, downward pressure on home values in New Jersey. Sorry, Florida, I don't have that analysis for you. Will buyers get frustrated, and look for alternatives, lowering competition, right? Wages are not likely to keep up with inflation, right? So that might put a cap on property values. Okay. So those are my my counter arguments. Anybody have anything that you think I've missed?
Homeowners insurance. That's gone up in Florida considerably, and we haven't had any hurricanes. So I would think the same would apply for New Jersey.
Utility costs also, Rob.
But I mean, I think utilities, for the most part, you have renting as well. Insurability and costs. So, Colleen, I have some good news for you. You want some good news?
Yes, of course.
So typically, insurance gets more competitive when the financial assets are performing well. And the reason being is insurance, for example, Warren Buffett, who you used to work for, he is a multi-billionaire, and where he houses the money to pay off insurance claims is in the stock market. And when the stock market does well, basically you're getting a free premium due to competition. And what I mean by that is if, Berkshire Hathaway, Geico, or New Jersey manufacturers invest a substantial amount of their money for reserves into financial assets, those financial assets increase. Insurance companies underwrite to a loss because they're expecting to make money on the return, the asset value or the asset return of that investment, which is a really interesting phenomenon that I learned a few years back. So insurance companies, if they expected loss on a workers' comp policy of $100,000 is $105,000, but they can make a 30% return in the market, they're making a 25% profit. Does that make sense?
Yep.
So I believe that insurance costs will be looking better in the near term, but I did put that down as a downward pressure. So those are my pluses and minuses. Anybody else want to throw anything in there?
Hey, Rob. I know on the commercial side, my insurance rates haven't really gone up, and thank goodness. And the buildings we have on the Midtown Direct Line. Unfortunately, they stay around 43 to 44 cents a square foot, and as you know, I do things at pretty much per square foot basis. But also, when you look at taxes, just going to your taxes. Taxes generally will range from 5 about $5, anyway, in the high fours to the low sixes per square foot for commercial assets. It just really depends where you are. Naturally, Bergen County is more. Bergen, Hudson, Essex are higher. Somerset is generally a little more relaxed. Monmouth is creeping up there. So it's always something good to know where you can even look at it on a per square foot basis as well, because it's easily quantifiable.
So, and Carlo, I appreciate that. And another interesting thing that you brought up is, like you have, you're like a stockbroker with a bunch of different stocks that you can invest in. You can go retail, you can go, different segments of retail, like the restaurant or hospitality. You can do hospitality, you can do office, you can do warehouse. Like you have so many different sub-markets that are available for investing. And I think that's going to be over time that will, if we're interested in this, we can evaluate those sub-markets independently.
The plurality of it, for everybody on the call who doesn't know, my background is institutional retail. So it was all supermarkets, big box. I would do, Targets or ShopRites or whatever. I mean, that's what I used to do. I moved away from that specifically because on the brokerage side, everybody was pigeonholed in just to going after one product type, and they would just kill each other to go and get it on the brokerage side. On the investment side, institutional investments, they all get their money from the same spot. They all get it from the Fidelities and the Vanguards and everything else, and it's all the same returns. And they were all looking for unicorns. So as Rob and I have developed Midtown, what we do, I mean, everything is plural. So our portfolio has everything from retail to mixed use, multifamily, industrial, whatever. And we have it in multiple markets throughout the country. And let me just say one last thing as it pertains to taxes. So, and Rob, this is the property I sent to you yesterday. So for those of you who don't know, we have Midtown has an office in Raleigh, North Carolina, which is an absolutely booming market. And if you're going to invest down there, because Apple just announced that they are going to build a $1 trillion campus in the Research Triangle, which is going to bring thousands of jobs, which is already going to make the property value spike more than it already is. But here's the best part. Because taxes in southern states like the Carolinas are generally run out of the county, and it is not run out of the municipality because they don't have the home rule provision like the state of New Jersey does, taxes are cheaper because you're paying for the county. You're not paying for the county, the state, county, and municipality like you do in New Jersey. You're actually paying taxes 3 times. So where we're having an office building that rents at $25 a square foot, we're only taking off $1 a foot maybe for taxes rather than 5 or 6. So that goes directly to our bottom line. Utilities are the same. Well, the other costs are the same, but just the fact that we're saving 60, 70% on our tax bill, that goes, it affects the assets so differently that it's an eye opener for us.
Right. So, I know I was watching a Yahoo Finance interview with Barbara Corcoran, and she said, "What's the best place to invest?" And I want to say she said Raleigh-Durham, North Carolina. So, anyway, if you're a follower of the Shark Tank or Barbara Corcoran and her investment expertise, I think she copied you, Carlo, because we were there first. So now I'm going to go into a little bit more on, I'm going to put that link there because you mentioned that, Carlo, into the show notes. But let's see here. All right, so let's look at the macro. Annual inflation by decade. If you're buying a piece of real estate, do you think that this is a pretty important macro component? Hello, anybody? All right, I'm going to call on you, Anthony, if nobody answers, all right? Do you
That's
think
fine.
is inflation important?
Very important.
Now, is inflation good for you if you put money in the bank?
No, the trapdoor is that it's falling out the bottom.
So if you put in money in the bank and you get 2% and inflation is 3, you have a negative return. You have a real negative return of -1. If you buy hard assets that appreciate, then you're participating in inflation. You're letting that serve you. Okay. This is the inflation trends by decade. Now, you see that spike in 1940 to 1949, right over here, folks.
Mm-hmm.
Okay. It went from -1.8 to almost 5. So it went from -2 to 5. That's a 7-point swing. And why do we think that inflation occurred there? If we go back to my earlier note.
GIs returning from World War II.
Well,
Wasn't it the reserve currency was pulled off of the gold note?
No, that was done in the Nixon era. But if we look here, the money supply increased by 26% in the past 12 months. You'd have to go all the way back to 1943, okay? In 1943, what happened? We went from negative inflation from the Great Recession, -2, to +5, a 7% swing. So does success leave clues? Does history repeat itself, Anthony?
Definitely.
So is that that's a positive there. And I apologize for being like all nerded out here, but I really wanted to do my homework for this group because I know you're at times you could be a tough crowd. U.S. debt. What do you think about that, Anthony, in terms of buying hard assets versus financial assets?
Well, I think that the U.S. debt is in a situation right now where the people who are in charge of the U.S. debt and the feds are trying to prop up our economy right now from external sources because we're just not getting enough investment in our bonds in America. So I think that what's going to happen is we're going to just keep printing money as long as everybody around the world allows it.
So do you know how much money the U.S. government owes per taxpayer? I'd like
like 100,000 or 150,000 per American.
Per citizen or taxpayer? Per American? So if you could put in the chat box, how much money do you think the government has borrowed on your behalf per citizen? And then I also want you to say how much you think the government has owed per taxpayer. Let's just put a couple of comments in there because I want to get to that. Let me stop sharing here and see if anybody's humoring me by putting that in there. How much money do you think is owed by each taxpayer? 160,000 from Julio. Audrey Plummer, how much do you think the government has borrowed on your behalf as a taxpayer? 150, 226 from Veronica.
Wow.
Nuana, how much do you think the government's borrowed on your behalf? 100,000. All right. So you guys ready to see these numbers here? Because they're staggering, I'm telling you.
Whoa.
Okay. Here's the U.S. debt clock. And I'm going to give you guys all an education, and I'm not trying to frighten anybody, but I want you to understand. Isn't that a busy page? So
all numbers are moving.
Yeah, so the debt keeps increasing. So I am not by any stretch an expert on this. I am giving you my opinion on this number here. And I've done some research on this 5 or 6 years ago with a gentleman by the name of Pete Peterson, who was a pretty significant investor and a philanthropist. Our national debt of $28 trillion is pretty frightening, right? But I want to bring you to the cost per taxpayer. Is everybody paying taxes? If you were to divide that debt up by taxpayers, it's $224,748 as of now. Maybe when this webinar ends, it'll even be higher. If you take it across all the citizens, it's over $85,000. How many people with $85,000 in student debt are struggling? Right? I mean, that's a pretty heavy burden to carry, right? But think that debt is burdened on every possible citizen in this country. Pretty eye-opening, right? Now, here is what I learned from Pete Peterson and from Alan Greenspan. Who by show of hands, who knows who Pete Peterson is? Anybody? Other than what I just told you? How about Alan Greenspan? If you heard that name, raise your hand. All right. So Angelique, who is Alan Greenspan? Putting you on the spot. Former Federal Reserve Chairman. Okay, and they used to say if Alan sneezed, like people would, or however big his briefcase was, would be determining what influence he was having on the market. You remember that, Robert? Like CNBC used to look at the size of his briefcase when he came out of the meeting. He was a very influential person. The reason I mention this is both Alan Greenspan and Pete Peterson say that we're being duped. Okay. And what I mean by this is everybody, do you ever see the thing that, hey, watch over here, watch over here, watch over here. I got you over here, right? Watch this. And then there's a diversion, right? Do you think politicians might ever do that? Oh, no. Anthony's saying no. We're going to kick you off, Anthony. So here's the challenge. Our debt is 28. And Anthony, do you have a calculator? Anthony or Robert Garver, if you can just take 86 divided by 28, what does that give us? 86 divided by 28. 86 divided by 28, somebody?
3.07.
3.07?
Yeah.
So let's just round it up to 3, right? So take 3 and multiply it by 225. What is that?
691.
691. So assuming that all of us on this call are taxpayers, that is the amount the government owes in debt and what they call unfunded liabilities per taxpayer. $691,000. That's frightening, isn't it? Hello?
Can't we just
Yes.
create a new currency?
Really frightening, which is why crypto has been so attractive to people, I'm sure.
So 691,000. So does anybody have a good idea how we can get out of that?
Just change the different formats that we use for a currency.
Print more money. Let the feds keep printing it.
All right. So you guys are pretty smart. So let me go back to my screen here, because this is a really fun exercise I did, and I think it's going to be really helpful in you deciding how you want to navigate this market. Where's my link here? So in 2009, right after the first financial crisis, where they had the Tarp Funds, anybody remember that? There was a study, and I believe it was by MIT, on how the federal government was going to use inflation to erode the national debt. And in other words, if you could borrow long-term at 3%, and then there's an inflation factor, you're going to pay back with grossly deflated dollars. Does that make sense? So I think some of you said print more money. So if the government does a couple of things, one is if it issues debt and then it pays back that debt over time with deflated dollars, it's in essence discounting that debt, right? So if inflation's at, let's say 3.5% and the government can borrow a 10-year bond at under 2, okay, there's an arbitrage opportunity there, in addition to the government having an incentive to pay back with cheaper dollars, right? Does everybody kind of buy this with me, or does anybody want to contest this?
No, because the indicator is as long as the feds keep lowering the rates, then people will continue to buy real estate.
Right. So we have a huge federal debt. The government benefits from keeping interest rates low because it has to repay the debt. We all agree with that. Here's an article I give you a link to. It's a rather lengthy article by some really smart people talking about how the federal government can use inflation to erode or pay the national debt off at substantial discounts. Now, I can tell you that another indication of this is the average maturities of Treasury debt has increased from 39 months to when the article was written, when they were talking about starting to do this, to most recently 70 months. So the government is now saying we're going to make contracts to borrow cheap money for a longer period of time because we know we're going to pay back with deflated dollars. Make sense?
We have to keep the interest rates low for much longer too.
Yeah. So, but is interest rates low for longer? Is that good for housing or bad? That's excellent for housing. It stimulates it. It makes it more affordable, right? So that props that asset class up. Okay. Here's a chart of the average maturity of federal debt. Okay. It took a little bit of a spike over here. And my theory on that is because interest rates had gone up, right? You know, remember like 2 months ago, interest rates went up. So I think the federal government didn't want to pay the higher rates on the bond, so they went short term. And I think they're going to optimize as interest rates drop. Is this enlightening to anybody?
Is that so that the government can just manipulate the debt, do you think, Rob?
Of course they can. With all the open market decisions that they make in this massive balance sheet, right? So most recently, the average maturity, and this is the chart, I thought I was broadcasting it before, has risen back to 65 months. The short-term borrowing was replaced by longer-term maturities. In the final quarter of the calendar year 2020, the share of total outstanding marketable Treasury securities represented by bills declined slightly from 24 to 25%. So all this information here is leading me to this conclusion, okay? And this is more clear to me than it ever has been, okay? This is more clear to me than it ever has been. And I'm gonna do this. I'm gonna adjust this. Good debt will be an asset. Good debt will be an asset. Cash is a liability because cash has negative real returns, right? And check this out. When I take these two and I add A and B, I get real estate as a hedge. So I personally am now more excited about moving forward in the investment arena. And I'm doing this primarily to educate everybody here who lives in the real estate world so that we now have a different perspective on what might serve us and our families so that we don't work until we don't want to work. We want to be able to control our passive income. We want to be able to control our destiny by investing wisely. And the example we did, I think it was last week or it might have been 2 weeks ago, we talked about how, 25% down payment, leveraging at 75%, borrowing, we could have positive cash flow, right? And then if there's any appreciation, that's going to be positive. Now, if we look at the fact that the government wants inflation, isn't real estate going to be a tremendous hedge for us, right? I'm going to put another negative is going to be, another downward pressure will be possible changes in capital gains taxation. And that might be limited to the higher priced or commercial assets. I don't know that this is going to affect a lot of the residential stuff. So this is my presentation. I want to get some feedback. What do you guys think? Please put your camera on and tell me I stunk. Tell me it was helpful. Tell me anything.
It's really good, Rob.
I have one fan.
One of the,
That was great.
Have more than one fan.
All right. We have
Yeah,
two-
it
I
was
have
really
5
good.
fans.
Thank you.
I think my head is spinning and I need to see it again. Hear it
Well,
again.
the good news for you is it's recorded. But all kidding aside, I think that this is one of the crossovers that for our wealth mission that we're on, it's going to help us. But it also gives us some tremendous insight into the real estate market. And that I think that if you were planning on the market crashing and taking it easy in the near term, well, forget about that. We're going to have an abundant real estate opportunity in the foreseeable future. All the stars are basically becoming aligned for us. And, the mass of people are actually operating in a very logical fashion. I want to call on Mark because you're an analytical. What are your thoughts, Mark Hagemeister?
A question I have, so I'm not as knowledgeable in real estate investing, but the question I have is about the effective inflation. So you've made the case that the government will be looking to inflate debt, and the impact of inflation on real estate evaluations. I tend to think of inflation going up, driving higher mortgage rates, making real estate less affordable, and maybe as another downward pressure on real estate prices.
So Mark, up is down, down is up. So you're thinking of the 70s and 80s where that happened, right? Where we kind of had hyper real estate inflation and people were borrowing money to just catch the real estate craze, so to speak. I think that that was right as we came off of the gold standard with Nixon. And we had that hyperinflation with Jimmy Carter. For those of you, Jimmy Carter was a president. So
don't forget the oil.
We had the oil embargo. There was a lot of interesting things going on there, Mark. But right now, what I'm saying is the government has now an interest in seeing that interest rates stay low because they're probably the largest debtor on the planet, right? With all that money.
Mm-hmm.
So they want to see real interest rates stay low. And we want to, if the government is doing something, and it's in their interest, I think that we want to be aligned with that.
Mm-hmm.
Okay. So, and everything that we've seen in recent history, do the Democrats want low interest rates and a good economy, Mark?
I think they do.
Do Republicans want low interest rates and a good economy?
They do. Yeah.
So here's where there's some commonality, right? Everybody that's in office wants to see this happen. So there's a partnership amongst the parties to see that this is one of the things that, hey, we can spend and it costs us less if interest rates are low, right? We get to pay back with discounted dollars. It probably is not a great story for your grandchildren,
right? But
it is real estate, in my opinion, and I feel highly confident. If I could say, where are my confidence levels on interest rates? Probably in the 70% range, maybe a little bit higher. But where's my confidence level on real estate being a hedge? It's extremely high. It's not a paper asset. It's a real asset, okay? And I'm looking at everybody on this call. I'm saying rents are going to continue to go up, okay? Even when housing adjusts, there might be a temporary pause on rents going up, but over time, rents increase, right? If we go with fixed term, low financing, we've locked in our pricing today over a long period of time. We're paying down our asset. Okay. I feel like 99% confident that real estate is the hedge that I want to be in because of these aforementioned reasons. Okay. And, you know, if we were going in to buy and sell, Mark, in 3 years, I'm not as confident, you know, 5 years. But if we're going to take these assets, take a 15-year mortgage on them, pay them off in 15 years. And even if the market doesn't go up a penny, right? If we're positive cash flowing on our money, and I think we're getting, you know, 6 to 20% cash on cash return, right? We have enough money to put some money aside if there's a, you know, a catastrophe or a major repair. We have availability to create credit relationships now. So if something happens, it doesn't even come out of our pocket. We have enough positive cash flow to cover those circumstances and the investments that I identified. And I'm telling you, you know, it took me maybe 4 hours in total to run through 300, 250 houses, you know, create a sheet. Now that my sheet and my methodology is already there, we can identify the top 10% of those. We can get together as a group, and, you know, some of them might be in a flood zone. Some of them might have other negative implications that eliminate them from our level of interest. But I think there's some tremendous investment opportunities out there. And I just want to share that with you, whether you come here and we do it as a group or you go and do it on your own. Okay. The technique for doing that is there. You know, I'm open to sharing with you if you have anything you want me to look at individually. Yes, Colleen.
Thanks, Rob. I wanted to say that if you look at the pattern of large investors, different institutional groups, public traded companies, they're all buying real estate. In Tampa, a large group purchased a new home construction. They bought all 50 homes that they're going to turn into rentals. So if you look at that pattern of what's going on, it's a good indication that real estate is an excellent investment. I think we're going to see more REITs coming around. I just, you know, agree with you 110%.
So what I want to do is, if there's no other questions, if you're interested, you know, and I'm not a Series 7 blue sky investment trust here. I'm just somebody trying to, you know, provide an opportunity for a group of people I care about to make some investments that are going to change your lives. All right. And I do believe that these are things that can change every one of our lives. If we just take a small piece, we put this money aside, we invest in it, and then, you know, before you know it, 15 years we'll be like that, and we'll have property that we own outright. That's my belief, and that's why I'm doing this. I'm not doing this, you know, I don't really strive to have the administrative process of doing all of this, but I do it because I really believe in, you know, what it's going to do for generational wealth and helping us provide an asset in the business where, you know, January 1 every year, we're essentially unemployed. We have to do it again, right? Okay, so we want to work on the passive income. Any questions?
Rob, you had said one thing, and that is that our grandkids are not going to be grateful. And I wanted to say to everybody here on the call today that if you take the opportunity that we're about to do, your grandkids, if you hold on to this investment, are going to own this and all of the upside. So it will cascade to them down the road.
Yeah, I mean, I would say that, Anthony, if we don't do anything, we're just pushing the debt down to a next generation, or maybe even 2 generations, by putting the debt into long term. So honestly, I think that, you know, as a family unit, you need to do whatever you can to provide for your family and yourself. And I think this is something that, you know, if you have the wherewithal to do it on your own, I'm more than happy to help analyze an investment for you. I promise I won't bid up against you. And if you want to do it as a group, I think there's a tremendous collaborative impact of doing that. I think it could be a fun thing to take us out of our mundane real estate business, you know, which sometimes gets to be a little bit, you know, tiring, especially when we're in these competitive situations. But, you know, from my lens, if we had it, you know, quote unquote, overpay a little bit today with the macro forces that are going to help us, as an investor, I think that we will be rewarded for that aggressive negotiating. And I think for your, consumers that you're talking to, we should now have an enhanced confidence level. And you might even want to include this as part of your buyer presentation. Who thinks that this would be really good as a buyer presentation, right?
Mm-hmm.
Yeah, and Colleen, I don't even think Warren Buffett did this, did he? He never shared this type of stuff with you. He's
No.
buying all the houses himself.
Exactly.
But from the heart, like I really believe like we need to do something. And this is my information I share with you. I'm telling you exactly how I feel, exactly what I believe. If you're interested and seriously interested, please talk to your manager. We'll figure out the how, right? How do we put together a group to do stuff? Maybe we start to have a committee, next week. I think we're going to start looking at some individual assets for those who are really ready to get rolling. And we'll figure out how do we take step one, right? And as much as we're all feeling like this market is overinflated, there's no good investment opportunities. I hope 2 weeks ago or a week ago, I kind of disproved that to you, at least at some level. And I think by, the attendance increasing, at least some interest must be there. So please reach out to your managers and let them know if you're interested. They'll consolidate that list and get it to me. Reach out to your managers, say, hey, I want to take a look at it. And we'll figure out how do we go about creating some wealth for everybody. Dan, you excited, Brosna?
Yes, sir.
Okay, here
All
is.
right.
Rob, there's a comment in the chat asking if you can analyze investments in Florida too.
Absolutely. I'll be down there on the 11th and 12th, or the 10th and the 11th. I'll see you guys down there. And for those of you who aren't aware, Robert, do you have the door knocking schedule from the email? The days I'm doing, I know the first, I'm going in Tinton Falls. I'm spending the entire day. I'm going to knock until I drop. I'll go like 7 to 8 hours. I hope to do like 8 to 10 miles. I'm going to do it again on Sunday. And Sunday is Somerset, Morris, and Middlesex, I believe, right?
May 2nd is Morris, Somerset, Middlesex.
Morris, Somerset, Middlesex on May 2nd. Let me mute everybody.
May 15th is Bergen County.
Robert, unmute yourself. May 15th, Bergen County, and then I think the 16th is Union and Essex. All right, so let's go get some inventory. Let's make some money so we have money to invest. If you're thinking of, hey, I don't really have, 5 or 10% to put aside for my retirement, I have a solution for that too, okay? You guys ready? Just make another sale and dedicate that sale to it, right? So if you make a sale for 10 grand, you do that once a quarter, you have 40 grand to invest. And if that money is going to grow at, 20%, that's going to change your life. It really will. It's the compound effect. Okay.
Rob, I have a question. Greg Morozek. I have a client looking for commercial properties. I understand he has some login information I can use for the commercial side.
So you'd want to talk to Carlo. You mean in terms of like CoStar or LoopNet, Greg?
Yeah, I'm not sure which one. I haven't even logged into any of them yet before. I have someone looking for. She has a couple $1 million. She wants to buy a shopping center.
Okay.
South Plainfield.
So Carlo Caparuba or Cheryl Darmani would be the people that will help you. I'll send you their contact info.
Thank you.
All right. So any other questions? I hope I passed the audition, folks. And this.
I had a quick question, Rob.
Go ahead, Jose.
The preliminary numbers came back from the census, I believe yesterday. Do you see any impact coming from population growth? I believe they're saying that it's been the slowest growth since the 30s. But I believe with immigration reform and as the COVID situation gets better, I believe those numbers will grow. But I was just thinking, what are your thoughts?
So, I'm looking in the individual markets. Okay. I'm not looking at the entire country.
Okay.
But for right now, New Jersey is stable to, recently it's seen some growth from New York migration.
Right.
But I don't see that being a massive change over time. And in Florida, you have a tremendous migration benefit that's going to more than offset the overall growth of the country.
Right, okay. All right. That makes a lot of sense.
All right. So everybody have a great week. Hopefully I'll see you on this Friday's mastermind, and let your managers know about Janet Lee. I'll get you the contact as well. And hopefully I see you on Friday's mastermind. All right. And let your managers know if you're interested. Bye, everybody.
Thank you so much.